Hey guys, good afternoon. What's going on? Hope you are well. It's lovely to see Angela and Dan. Where's everybody else? Come on, don't be shy. Turn those cameras on. I have to be on camera, so it seems like you should have to be on camera too. Isn't that a rule? I think we should maybe make it a rule.
No,
No, it shouldn't be a rule.
I don't want to show my pajamas.
Oh, well, there's a way around that too. All righty. So just wanted to start off today with some questions, really. I mean, especially with a smaller group, we can make this as specific to your needs as possible. One quick disclaimer: I am not an accountant. Right? I sometimes play one on TV. However, I am not an accountant. So I am happy to work through the conversation that we're set to have today regarding how taxes work when you're in the real estate industry, because I find that the more people I talk to about how they're either paying or not paying their taxes, when they're paying or not paying their taxes, and how they're working their closings around taxes, is the spectrum is quite wide, right? And so I want to make sure that we start kind of basic and then move to wherever you want to move to, so that you all are all working from the same info. And so again, as with anything, when it comes to legal conversations or tax conversations or any of those things, do make sure that you verify anything that I say with your own accountant, because I'm going to speak in generalities, and there may be some things that we talk about today that don't really relate to you in your particular financial scenario, right? I'll give you just a quick example. One day last year, kind of in the midsummer, Debbie and I share an accountant. We also own pretty much everything that we own 50-50, save our personal things. And so we're about as up in each other's financial business as one can possibly be, and not be a married couple. And so our accountant sent me something and said, here, why don't you go ahead and process this and send it back to me for X, Y, and Z reason. And I said, yeah, that's great. And I'm actually meeting with Debbie shortly, so I'll tell her about it as well to save you the conversation. And he came back to me and said, well, thank you for that, but no, don't do that, because it's not really relevant to Debbie, because Debbie has X, Y, and Z, and you have A, B, and C, right? So even people who seemingly have very similar tax foundations can handle things differently based on their own financial scenarios. So that's just a long way of saying we're going to talk through what you want to talk through today. Do make sure that you have these conversations as follow-ups with your accountant, just to make sure that the ideas that you might hear are relevant and specific and beneficial to you and your household and your specific financial situation. Make sense? Is that a long enough disclaimer to get me off the hook, just in case? All righty. So talk to me for just 2 or 3 minutes about what it is you want to be certain we cover today, so that I know where your head is at. What are the things that are on your mind? What questions do you have? What do you want to make sure we cover? Just unmute and I will call on you as you unmute. Angus.
I know that there's 2 ways to monetize or take into account mileage in cars and things of that expense. So, but I don't know exactly what they are. And frankly, I don't want to get audited, so I don't generally include any gas or fuel or travel. So I just wanted to know if there's a way to do that the tax authorities won't raise a red flag.
Got it. I put that on the list. We will cover that. Anybody else? Yes, Lydia.
Hi. I'm just interested to know that if you incorporate or create like an LLC, how does that work with regards to, you know, putting real estate business under that umbrella? Just curious if you know anything about that.
I do. I'd be happy to give you that info that I have. So yes, we'll put that on the list as well. Go ahead, Raquel.
So I don't know exactly how to word this, but when you have all these expenses in your business, and so I guess you put them in as deductions or expenses, but then your total, like, I guess, profit at the end, right? You have a total profit at the end. So say you wanted to get a mortgage, then all those like deductions and expenses kind of hurt you. So is there a way to kind of how to manage that? So if you want to take them, like I have all this money and I want to like invest in a property, but if I get a mortgage, that's going to hurt me now because does that make
Got
any sense?
You know, it makes total sense, and I will. I'll address that as best I can. There may be ideas and strategies that a CPA could further assist with, but I'll address it from where I sit, and then we can go from there.
Thank you.
Okay, Sherry Lee was next. Go ahead.
I don't know if this pertains, but I'm doing some pro bono work and someone suggested to me in cleaning out a house and doing this for this house that I'm listing. Can I write a pro bono invoice and deduct it? Is that worth it? Is it, you know?
Okay, we will address that. I'm not sure I have a great answer for that, but I will do my best. Go ahead, Eric.
Yeah, thanks, Rick. Quick add-on to Raquel Martin's question, amortizations included in that. And the second part, or my question was like, what advice can you give us, without speaking to our accountant yet, about home office expenses?
Home office. Okay.
Thank you.
Sure thing. Sonali, go ahead.
How about gifts and donations?
Gifts and donations. Perfect. We can talk a little bit about that. Dawn?
Hi, can you hear me?
I can. Oh, now you're muted. There you go.
Okay. Just like quarterly payments and like what happens if you miss them and.
Got it. So let's start there. And if you have any other thoughts or questions that pop up during, pop them in the chat or unmute, and I'll give you a shout to put that question on. Let's kind of start foundationally, and we'll kind of pivot to Dawn's question first, because it is that foundation, right? In the United States, what we know is that the tax code says that you owe taxes as you earn the income, right? So you owe your taxes as you earn the income, which is why when you're a W-2 employee, there are mandatory withholdings from your pay, because as you earn the income, it has to be sent to the government, right? Payroll companies manage all of that. When you're a W-2 employee, it's kind of invisible to you. But you see how that system is set up, right? So that as you earn the income, the government gets their portion. Now, as 1099 wage earners, you are not exempted from that. You still owe taxes as you earn the money. Now, in order to not make it ridiculous, especially in an industry like ours, where Herm gets paid today and Marcel gets paid tomorrow and George gets paid the next day. Everyone just gets paid kind of whenever there's a closing. So in order to not make things crazy, the government said, all right, for 1099 wage earners that may have more sporadic income, we'll set up 4 times a year, known as your quarterly estimated payments, for you to pay the taxes on the money that you earned in the previous quarter. That's how the tax system in this country is set up, right? So there is this myth out there that I want to dispel, that somehow paying quarterly estimated taxes is somehow optional. It's not optional, right? the way the tax code and the law is written, you pay your taxes as you earn the income. In your scenario, it's not every closing per se, though I'm going to suggest it be that way. I'll give you that as a strategy shortly, right? But you pay it by accumulating that money as you earn it and then paying it quarterly. The quarterly payments are April 15th, June 15th, September 15th, and January 15th, which if you notice is not exactly quarterly. Some of them are tighter together. Some of them give you a little more time, but those are the 4 payment dates, right? And if the 15th falls on a holiday or on a weekend, they maneuver the day around a little bit, but April 15th, June 15th, September 15th, and January 15th. And so Dawn asked the relevant question around that is, okay, well, so what if you don't do that? What if you don't pay your quarterlies when the quarterlies are due? And there's an answer to that. Does anybody know what the answer is? The answer is not jail, at least not right away.
Fines.
Yeah, so penalties and interest is the answer, right? Penalties and interest is the answer. I was having a conversation with one of your colleagues the other day who said to me, I asked about taxes. We were talking about money, and I asked about taxes, and he said, well, I have this huge tax bill coming due because now the taxes are due May the 17th this year. And I've got to write this big whole check from the whole previous year. And I said, well, what do you mean? He said, well, I have to pay the taxes. I said, well, I understand, but really it should only be the overage, right? From anything that you owe that's on top of the estimateds that were set up for you last year. And he said, no, I don't do it. I don't do it that way. And I said, oh, okay. Can you talk to me about that? Because at his income level, the penalties and interest are enough that I don't know about the rest of you. I'm more than happy to pay my fair share of taxes, but I am not happy to pay a penny more than what I am required to, right? So penalties and interest, I'm not sure that's going to work for me. And what was interesting is that he was pretty certain that was not the case. So I encouraged him to go back and check his last couple of tax returns or have a conversation with his accountant as to why or how he was escaping the idea of paying quarterlies. There are a couple of scenarios that if you are married and filing jointly and the one spouse has enough withholdings that might cover your income as well, because it's all on a joint tax return. There are scenarios out there that I can see that may allow for you to not pay your quarterlies. But there are very few scenarios, and the other income earner in the household would have to be earning a good sum of money and then having an even larger sum of it withheld, right, to cover your quarterlies as well. So the answer to Dawn's question is, what happens if you miss them? Well, you pay penalties and interest, right? And then it's all due April 15th or this year, a month later, right, of that following year. Typically, however, what they look at is there's a safe harbor law, right? And that safe harbor law says your accountant will look at the taxes that you had to pay in your previous tax year based on your 1099 income. And so they take that amount and they pretty much divide it by 4 and say, okay, if you pay at least what you paid last year, if you earn more and have to pay more taxes this year, we won't hit you with penalties and interest. It's the way around penalties and interest, right? That's the safe harbor idea. And that exists both at the state level and at the federal level. So if you made money as a 1099 wage earner in 2020, your accountant should have set up for you what those quarterly payments are for 2021. You should have little envelopes with little payment coupons. So let's just say you paid $30,000 in taxes last year, right? Well, $30,000 divided by 4 quarters is $7,500 a quarter. And so as long as you pay $7,500 a quarter this year, even if you make 3 times as much money, you'll still owe the difference at the end, but the penalties and interest should be abated. Does that make sense to everybody in terms of just kind of setting that foundation for estimated?
Makes a lot of sense. Can I ask one question?
Of course.
So, well, so withholding taxes is based on your prior income, estimated income? Is that what it is?
So the quarterly payments for Safe Harbor are based on the total tax you paid in the previous year as a 1099 wage earner.
Okay.
Divided by 4. That's how that works. And so, simple strategies, guys, to help you with this, say that when you have a closing, 30% or so, right, depending on your tax bracket, please don't forget that you pay taxes not only to the IRS, but to the Department of Revenue Services, or if you live in New York, to the, I can't remember the name of the taxing agency there, but you pay state taxes as well, right? So you have to add them together. Every time you have a closing, do you set aside that portion of those funds in a separate tax account so that you're just accumulating them so that when the quarterly payment comes, you can make the payment? If you're moving all of the money that you get into your personal account and just paying bills and living life on that, one of the things I want you to walk away from today with is an understanding that you are now living above your means because you are spending money that's not yours, right? That 30% or so is not your money to spend. And when the government comes a knocking, if you don't have it to give them, well, now there's more penalties and more interest. So you've got to start to adjust your expenses, your income and expenses at home to live on the 70% or so of the income that you actually earn, because that's how much of it is actually yours. For those of you who had W-2 jobs, you know that the paycheck you get is minus those withholdings. So you're living off of your net. You don't get to spend the government's money. However, in our scenario, most of you do get that opportunity. And if you're not careful, you can run into some real struggles. Now, transparently, I will tell you, I have done this really, really right, and I have done this really, really wrong. So I am in a unique position to say to you that when you do it really, really wrong and you choose not to pay your estimateds, less pleasant things happen over time, right? I've also, in the last 10 years, enabled myself to set up a system to do this really, really right. And so when you do it really right, that date comes and you think, oh, I just have to write a check out of this account instead of this account. The money is there. You don't have to worry about the money, right? But it's truly a matter of creating a separate account. And when I say creating a separate account, I mean create a separate account that's not linked with your other monies. Or if it is linked, it takes days or a week for the money to transfer. You don't want the idea of instantaneous access to those tax funds, right? You want to make it hard. Mine are at a separate bank in the cloud, so I don't see them. I don't think about them. I just move them, and then we're away. All right, so let's see. What if I do not earn income and only incur expenses? Do I still need to report? So talk with your accountant about that. If you are if there's no income and yet there are expenses in order used to earn that income, even if nothing showed up, you should still have a loss to report, right, on your Schedule C. And sometimes, depending on how the loss is built and what the loss is built from, sometimes those losses, if it's qualified business income, can roll to the next year to offset income that you earn the next year. But again, get better clarity from your accountant on that. I would say, though, that you should still file outlining the fact that you planned on earning and then only had losses. How much should we set aside from each deal? I think 30% makes good sense. If you're in a higher tax bracket, when you add in the 6 or 7% Connecticut state tax with 35%, 30%, 35% to the IRS, you're probably closer to 40. If you're looking at this thinking, okay, how am I possibly going to live if I have to set aside 40% of every paycheck I get to pay my taxes, then start with 20%. Start with 20% or 25% and recognize that you have a challenge in that you have to either make more money or reduce your expenses at home, because you're not earning enough to pay your bills. Yes, and Stephen answered that question similarly, and Angus, yes, indeed. Okay, good. So anybody confused or have any additional questions around paying estimateds and the strategy that I encourage you to use every single time by setting aside that amount of money? I know sometimes it's tough. Like, okay, well, I have high bills this month. I get it. But trust me when I tell you, again, as someone who's done it wrong and done it right, that first year I did it right, when that first time came to write the check for the estimated, and I just went to a different bank account and wrote the check, oh my goodness, there is no better feeling than that. And then at the end of the year, when I only had to pay a smidge more because I made more and owed taxes on the difference and didn't have to find this enormous number. Like, I don't know about the rest of you, but every April I would think, I wonder how hard bank robbery is. I wonder if I masked my face, if I could, pull off a convenience store holdup. Like, where was all this money coming from? And it's literally just a system that you put in place. It takes some adjusting on the expense side at home, but it's just a system. And as somebody just said, who was that? As somebody said, it forces you to live within your real income. That must be Debbie. Raquel asked, did you have the separate bank accounts as a business account? So that's a great question. I always found personally that business accounts cost more, so I kept them as just regular accounts and just treated them as business accounts because unless you're incorporated, it's all in your name anyway. Right. The only time I saw that kind of backfire on people is that some banks last year weren't issuing PPP funds to us if we didn't have an actual business checking account to put the money into. And so some people just opened them for the PPP funds. All righty. So let's get into some of the questions that you asked. So expenses. So you know what, I'm gonna jump around a little bit because there's a flow to some of these that might help if I answered them in a certain order. And so I want to go to Lydia's question about incorporation. In the state of Connecticut, if you choose to incorporate and have an LLC become your business entity, the only way that the brokerage can pay the business entity, which is really the only way it makes sense to do it, right? Because if we pay you personally, well, then you're reporting the taxes personally. So we'd have to be able to write the check to the business entity, to Lydia Rousseau LLC. The only way we can do that is if Lydia obtains her broker's license, so not her salesperson's license, obtains her broker's license, and then uses that broker's license to legitimately license the legal entity, the corporate entity, the LLC. Once the LLC is brokered in our state utilizing your broker's license, then the brokerage can pay said LLC, and the tax return then would be based off of the LLC. There are pros and cons to all of that. However, the jumping off point is you actually have to be a broker first, and then start your LLC, and then go ahead and use your broker's license to broker that LLC. I know a couple of you in this room have done that. Debbie, I know, has done that. Jody, I know, has done that. There may be a couple more of you who have done that that I'm missing right now. But that's the path forward. Yes, Jody. Were you just raising your hand saying I did it?
No, I'm trying to find the unmute button.
Got it.
Yes, I did set up an LLC, but apropos to your comment about speaking to your own accountant and what works for you, I do not get paid from Keller Williams into the LLC.
So there wasn't enough tax benefit, or there was more tax benefit for you to receive that money personally based on your household scenario and how you file your taxes.
Correct.
Yeah, right. So there's a perfect, thank you for saying that, because it underlines the importance of the point I made right at the top of our time together, right? So it seems like, oh, look, I can do it that way, except when your accountant looks at it, there may not be as much benefit as it looked like. But that is the way you can do that, Lydia, and that's the only way you can do that in the state of Connecticut.
Thank you.
You're welcome. So that being said, let's talk a little bit about expenses. So remember, as business owners, you need to track your expenses daily. You need to know what it is you spend in order to make money. The tax code in the United States ultimately says that as a business owner, and when you are self-employed or a 1099 wage earner, you are considered a business owner. Right? Business owners do have opportunity that other mere mortals do not. And the opportunity that you have are writing off business expenses, right? And a business expense when you're a business owner is defined in the tax code as anything that you spend towards the idea of earning more money, right? So anything you spend that is spent with the intent of earning money. So for you, what does that include, right? There's a long list of things that includes, right? Any of your licensing fees that you pay are business expenses. Any marketing costs, any ads you run, anything it costs you to list houses, your MLS dues, right? Any and all of that. Your what is about to become an annual fee to KW, right? It's now a monthly, your $25 a month. Anything that you pay to KW except company dollar and royalty, right? Let's just make a quick bunny trail over here. Company dollar and royalty are not expenses to your business because the income that we report to you as 1099 wage earners in our company is already net. It's already minus the company dollar and royalty. Your 1099 is only reflective of the check that you actually receive. So you can't go back in and add company dollar and royalty as an expense. Does that make sense? However, if you pay transaction, once you cap and you pay a transaction fee, or say we bill you back for your attendance at family reunion because we bought the tickets and then you said, please take that out of my next closing. Or you went to Bold and we took that out of your next closing. Those deductions do not show up in the 1099 that you receive, and you need to kind of track those and know that those are expenses to your business, right? For many of you, a computer or a phone, including what it costs to run the computer and the phone, are going to be business expenses, right? You're in real estate, your phone kind of is your life. Now, depending on how much you spend on some of those things, your accountant may direct you to capitalize some of those expenses. From a tax perspective, what that accountant is saying is, instead of taking the full deduction, if you spend $5,000 on a new laptop, I can point you in a direction of not having to spend that much money on a laptop. But just for example's sake, if you did spend $5,000 on a new laptop, your accountant might say, okay, let's depreciate that over time instead of taking it as a single expense. And oftentimes those decisions are made based on the IRS coming back and saying, those expenses seem kind of high. Maybe we need to dig into that a little this year, versus let's go ahead and capitalize it and depreciate it over time, right? So your accountant can give you answers to that. Go ahead, Angus.
How much, I mean, I get a big monthly bill on my iPhone. I think it's $130 or something like that at AT&T. How much of that can I deduct without raising a red flag?
Yes, that's a great question. And here's where I will answer from the perspective of if that phone is primarily used for business purposes, you are likely okay giving all that information to your accountant and having most, if not all, of those expenses deducted personally. Deducted as a business expense. Some of that is going to be based on, okay, so if you earned $15,000 in real estate last year, you probably didn't utilize your phone. So if your income in real estate is low, the argument could be made, well, you didn't need to utilize your phone for 12 months straight to create that much income, right? And so there may be some questions that get asked by the accountant, but generally speaking, I think from a phone perspective, because generally speaking, we're using our phones for primarily business purposes. I think you kind of go for the full amount. But again, your accountant will tell you whether or not he thinks or she thinks that's over the line. Let's pivot a smidge to home offices, because it kind of goes along with Angus's question about how much of a certain expense can I take as a business expense. Because the other way to look at your phone expenses are in relation to perhaps your home office. Now, you are certainly allowed to deduct expenses to running a home office if in fact you do so. However, the home office deductions are going to be limited to the portion of your home that is your home office, right? So Jody's sitting in her office, right? Jody's got her MREA book behind her, so that we know full well it's her business office. It's where she runs her MREA team out of. And so therefore, there we go. Thank you, Carol Merrill. And so therefore, Jody's going to take a home office deduction. Now, if that home office deduction, if that home office that Jody's sitting in, let's just make the math easy, right? Is 100 square feet, and Jody's house is 1,000 square feet. Well, then the expenses as it relates to running the house can be deducted as business expenses up to that 10% level, because 10% of Jody's home is used for primarily business purposes, right? And so that means the heat and the electric and the insurance, things you use to run your home, there are portions of that can be utilized as a deduction for a home office. Again, only in proportion to the actual space that Jody takes up in her house for business. Does that answer I can't remember who asked the home office question, but does that answer what you were looking for in terms of home office expenses?
Yes, Rick, thank you.
You're welcome. And again, someone asked me recently, well, what about my mortgage payments? And the mortgage payment is you're just paying back a loan, right? So certainly none of the principal, and likely none of the interest, although maybe some of the interest. Again, you can ask your accountant if breaking down your mortgage payment makes sense for part of the home office deduction. None of the principal is likely to be deductible. A portion of the mortgage interest maybe as a business expense, and then if you escrow taxes and insurance, a portion of each of those may be attributable to a home office business expense. But again, verify that with your accountant. And so going back to Angus's question, it could be that you decide that 80% of your phone is used for business purposes and 20% is for personal purposes, and you only ask your accountant to deduct 80% of the total number of total phone bill for the year as a business expense, right? Some of those are going to be decisions that you'll have to make, knowing that if you ever got audited, you'd have to justify them back to the IRS. That brings us to mileage in cars. Let's have a quick convo on that. In our profession, I think you're crazy not to utilize one version or the other of a car expense deduction. And the two ways that you can deduct your car expenses are either the actual mileage and expenses based on the amount that you use your car for business, which means you're now tracking, did I say miles? I didn't mean miles. The actual expenses plus depreciation of the vehicle that were real. So you track everything. You track how much you pay for your auto insurance. You track how much you pay for gas. If you got new tires, you add in the expense of the new tires that you added on. And then you give them all of that information, and the accountant will then ask you, okay, well, how much of this is personal and how much is business? And so again, maybe you decide that 80% of it is business and 20% is, or 50-50, whatever the numbers are. You have to be comfortable with the numbers, knowing that you have to defend it to the IRS if you ever were audited. The other idea is you don't track anything and you just simply keep track of miles, right? You keep track of miles, business miles in particular. And so if you keep track of business miles, then you report the business miles to your accountant. And there's a calculation that's done based on miles. There's a certain amount of money per mile driven for business that gets calculated, and that becomes your deduction. So there's two ways to do it. Both are completely legitimate. Again, I would absolutely ask your accountant if there's a benefit to one or the other in your scenario. Who is Moto Z4 who just unmuted?
It's Tamamoto.
Hey, Tamamoto, what's up?
I just want to throw out there to people that there's a couple of apps out there, and I use Mile IQ, and literally every time I get in the car and drive, it tracks my mileage. So I don't have to, keep a notebook and say, oh, I did 5 miles here, 5 miles there. And then you can, you swipe left or right if it's business or personal. So, and then you can download it at the end of the quarter and into an Excel spreadsheet and hand that to your accountant as your backup.
Love it. Yeah, any kind of apps that make things simpler. Thank you for sharing those, because those are important. Or make sure you have a notebook and just kind of write that in each day, and whether it was personal or business, right? Tracking is going to be key, whether you're tracking the actual expenses or you're tracking the mileage for the mileage deduction. Please note, it's not both. You don't get to take both. You get to take one or the other. So there's Hurdler, there's Everlance, there's a whole bunch in the chat in terms of the apps that were discussed. What about leased? What if the car is not in your name? So if the car is not in your name, great question, and I'm going to defer to your accountant on this, but I believe the answer, if the car is not in your name, is that you may struggle with that as a deduction, right? There are benefits, pros and cons to having things in your name or not in your name. You can certainly, with a car that you drive that's not in your name, you can certainly give the information to the accountant. The accountant can use it as a deduction. However, if you ever got audited, the IRS may come back and say, okay, well, you don't own this car, so you may have been driving it, but the wear and tear on the car is not yours. It's this person, and so maybe they could take it as a deduction, but you likely can't. So that's a sticky wicket, or it could be. I know that one of the things Debbie and I did a couple of years ago is we each bought a car in the name of one of our LLCs and registered them inside of one of those LLCs. So it's an LLC that she and I own 50-50. So if she bought a car and I bought a car, right, it kind of kept everything even Steven. And yet inside of the LLC, then we got business deductions. We got a Section 179 accelerated depreciation deduction that one year because the car's values were X, and we looked for accelerated depreciation because it was a business purchase, right? And when you're in real estate, a car is a pretty valid tool that you need to go ahead and do your business. So it doesn't really raise red flags that we would buy a car inside of that business since it was a real estate business. And then to this day, we each just kind of utilize a credit card off of that company to buy gas and pay insurance and things like that, so that those vehicles, those expenses for those vehicles just live inside of the named owner of that vehicle and just are easily deducted as business expenses. And because it's an LLC, it's a one-for-one business expense, because then we're only actually taxed on the paper profit from that company. So just as some additional thoughts on mileage and cars, but I would say that I would encourage you to do one or the other. It's perfectly legitimate. If someone has said to you that car deductions or tracking mileage in any way is a red flag for the IRS, I do not believe that to be true. And I think that especially because it is so defendable in the business you're in, it's a decent deduction that you're missing out on. So you're paying more taxes than you need to if you don't utilize it. Leased cars, Shirley, that's a great question. Leased cars, you don't own the leased car. So you'd have to ask your accountant about how the lease payments actually work, because I'm not 1,000% sure on that. So Eric says it's my wife's car. And so if it's your wife's car and if you file US tax returns jointly, you shouldn't have an issue. If you file separately, you may have an issue, right?
Thank you. It's actually my wife's car and she leases it.
Got it. Yeah, when leases come in, I'm going to direct you back to your accountant because I'm not sure 100% how that all works. So, cruising on through, let's see, what other questions do we have? What haven't I answered? Pro bono invoice. Let's go back. Shirley, ask me that again, right? So you're doing pro bono work in what respect? In what industry would you categorize as pro bono work?
So I'm readying a house for marketing, and it's about to go live in June. So it's an estate and I'm cleaning it out, and it's a friend's house also. So it's a complicated thing for me, but, and I don't want to bill them for that. So someone said, oh, you should definitely take a deduction of that, do a pro bono invoice. And so I don't know if that's kosher or not. It's, like I'm readying the property. I've hired the people for cleaning the land, doing the landscaping. I'm hiring someone to do the estate sale. I'm hiring all of that. So it's a lot of time and I'm not charging them for that. So that was my question.
Yeah, got it. So my quick answer is, and this will definitely be a check with your accountant answer. However, my quick answer prior to the accountant's answer is, to me, pro bono is pro bono, right? If it's like, you can't have your cake and eat it too. You can't decide you're going to have pro bono and then create, because the invoice itself would, the way I'm hearing it, would be some sort of a false invoice, right? Because you're creating an invoice, no one's actually paying that invoice, right? So I'm not sure how one would reconcile that. Go ahead, Debbie.
So and again, this is a check with your accountant. There is a deduction that you can take for hours donated. So you need to, you would need to have some kind of invoice. I'm actually doing this right now for an organization that I work for, and the treasurer is going to write me an invoice that says, this work was worth this much money. So I think you can do. There is a space on the IRS forms about donations, because you can do miles driven for charitable work and that kind of stuff, but check with an accountant.
Thank you, Deb.
Got it. Perfect. Thank you for that. Which leads us to gifts and donations, right? And so what we know from both licensing law and the IRS is that actual gifts to clients are limited to, I believe it's still $25 per occurrence, right? So if you're buying closing gifts and the closing gift is $100 gift card, or a $50 wine and wine glass set, what you are supposed to do is only deduct up to $25 of that. Again, that's a licensing law thing and an IRS thing. We're here to talk about the IRS side. Just know that there is a corresponding statute in our state that says you're not supposed to actually spend more than $25 to say thank you to a client for a referral or for a closing gift. $25 doesn't buy you all that much nowadays. So, take that for what it's worth. And yet on the IRS side, that is the rule as well. As far as donations are concerned, charitable donations are certainly a thing. I would absolutely make sure that you have documentation for it all, including, if you give, $100 each week when you go to church, I would not do that cash. I would talk with your house of worship and see if there's a system in place. Usually in most houses of worship, there's a system in place where you're saying, I'm going to pledge this for the year, and there's an accounting of it, and you kind of, put the money in the envelope so that it's tracked to your name, so that if you ever needed to prove to the IRS that's where that money went and it was a charitable donation, you had a paper trail. Minimally write checks, not cash. Write on that kind of stuff. Jody.
Regarding closing gifts at $25 each, I'll do the Justin Kim spiel. Obviously, if it's something that has your name on it, it's considered marketing dollars, which is a full tax deduction. So, whether you do something like Cutco knives that have your name on it, or, you purchase a whole bunch of things like, we have blankets that say Boxer Realty Group and things like that. Cutting board, there's so many gift items that you could have your name embossed, which certainly from a marketing point of view and having your name in front of your clients post-closing all the time, it's a great thing to do. And then it becomes a marketing tax deduction rather than having to worry about only $25 being tax deductible.
Yeah, beautiful. Thank you so much for that reminder, because that's an excellent reminder. Right, anything that you can purchase as advertising or marketing. So clearly, if it's branded, it's advertising and marketing. There are no limitations on that. Brilliant. Okay, I think those were the questions that you put on the table. What else has come up in our conversation that you want to make sure we cover? Anything else that's burning a hole in your brain or that you're uncertain about? Yes, Debbie.
Yeah, hello.
Yep. What you got?
Yeah, about the quarterly, I know sometimes like I haven't paid the quarterly. Could you pay to catch up on 2 months, pay one check if you missed a January or some other month?
Yeah, great question. Great question. And the answer is absolutely. Right, you can definitely catch up, and as a matter of fact, I encourage you to catch up if you've missed something. And here's why: because your penalties and interest are based on when the money that was due to the IRS actually arrives at the IRS or the Department of Revenue Services. So if you say you missed January, well, let's use a different month, because January is that weird one that's really the previous year. So let's say you missed April, right? The first payment of 2021 was April 15th of this month, of this year, so 2 weeks ago. If you missed that one because you didn't have it, and you have it on June the 1st, you have it on May the 15th, send it to them on May the 15th. Because what your accountant may be able to do, even though it was late, is may be able to massage things so that the penalties and interest are less than they normally would be if you waited an entire quarter, because now you're paying interest on a longer period of time, and the penalties go up. So it's a matter of when was it due, right? Because again, in the United States, it's due as we earn it, and the government has given us the pass of to quarterly instead of per paycheck. So pay it as soon as you can. I also asked my own accountant one time, look, if I don't have enough one quarter, who should I short? The IRS or the Department of Revenue Services in Connecticut? Right? If I have to short one, who should I short? And he said, this may surprise you, I would short DRS. Short the state. Excuse me. Sorry. That's the wrong answer. I said it wrong. Short, pay the state, short the IRS, right? Because the Department of Revenue Services is far less lenient in terms of being able to, for your accountants to kind of move the money around and make representations about how and when you earn the money throughout a specific quarter and how it spreads out across the year than the Department of Revenue. So the Department of Revenue Services in Connecticut, so the state monies, you either paid or you didn't pay. There's a little more flexibility on the IRS side. So his advice to me, again, check with your own accountants, I encourage you to just pay both. However, if in full, if all of a sudden there's a shortage, my accountant advised me to always pay Connecticut in full. And if you have to short somebody, short the IRS and then make it up as quickly as you can. It likely nets you less taxes and penalties, interest and penalties in the long run than if you did it the other way around. Jacqueline asked, what was the book that you recommend that we read on taxes? It's called Tax-Free Wealth by Tom Wheelwright. Tax-Free Wealth by Tom Wheelwright. In it, what you'll find is a whole bunch of strategies as business owners, as real estate investors. If you are both of those things, you are two of the most tax advantaged groups in the United States. And if you start doing the right things, you will start to see more and more tax advantages from being business owners and real estate investors, right? Here's the thing, too many real estate agents treat their income as if they were W-2 employees. W-2 employees get very few tax benefits and advantages that are available to us, legitimately available to us. The coolest thing I learned from this book is that about 95% of the tax code, or maybe even more, is written to help you avoid paying taxes. They're the deductions, they're the incentives, they're the, if you put your money here or spend it this way, you pay less, you pay nothing, you get a deduction, you get a credit. Only a very small portion of the tax code is actually written as here are the things you are doing that we're charging you money for. Right? Very small amount is written to collect the taxes. Most of it's written on what are the legal ways to avoid paying taxes. So it's a fascinating read. And when you start to recognize that taxes are not, oh, woe is me, the little guy can never get ahead, poor me, right? Taxes are just, my lot in life, zippity-doo-dah. If you read this book, you think, well, that's not right. It's how the rich get richer, just by the way, right? Because they understand how the tax code is written. And they start to do things that are more tax beneficial to them for their money. It's called Tax-Free Wealth by Tom Wheelwright. Any other questions on taxes as we have just a few minutes left? Anything we left out? Anything that you're confused about? Going once? Going twice? All right, so do me a favor. If you do nothing else from our time together today, set up a separate tax account. Go to your bank, or go to not your bank, even better, and open an account. That is your tax account. And every time you get paid, set aside a certain amount of those funds. If you can't jump to the 30 or 25 or 40% right away, do a certain dollar amount. Make sure that you're saving $500 out of each check or $1,000 out of each check. Start saving money in a separate tax account based on every single closing if you do nothing else from today and set it aside. Trust me when I tell you, it feels so much better than waking up April 14th, realizing that, when I would wake up in mid-April, praying that some relative that I didn't know had died overnight and left me money, right? Who gotta be somebody out there, right? Versus just writing the check. It's a very different way to live. And what's interesting is, for some of you, it will be a very different way to live in order to have that very different way to live, right? You've got to make more and spend less to create that delta so that 30% is the government's and you're not spending it, right? You don't have permission to spend that, which is why they charge you penalties and interest, because you're spending someone else's money. You're actually taking a loan from the IRS when you don't set aside those funds and pay them when they're supposed to be paid, right? Think of it that way. Think of it that way. Would you take a loan to go to Stop and Shop and buy your groceries? By not paying your quarterlies, some of you are doing just that. You're taking a loan to live life, which means you're living above your means. So just make those adjustments, right? All right, guys, that's what I have for you today. I hope that was helpful. And again, I wanted to just end by saying anything we talked about today, please do verify with your own accountants. Don't just take our word for it. Please go ahead and make sure that reconciles with your specific financial scenario and the advice that you're getting from the people that you hire. This is really just to kind of in general talk with you about what those opportunities can be and what many of us do legally to make sure that we reduce our tax burden. This was absolutely recorded, so it will show up in the YouTube channel either late today or tomorrow morning. Guys, have an awesome afternoon. We'll see you soon. Don't forget, taxes are actually due May 17th this year, so a couple of weeks.